Perry here with the Rant on August 8th. Boy, does this look like 1929 in so many ways. I've been, reviewing all types of stuff in the last so many days and weeks. And I mean, if you go back then, we had the biggest immigration wave ever into our country. First peak in 1907, then a second highest surge ever into 1914. Now, with immigrants, they already come in age 30. I'm the only one that knows that number, too, demographic. 30 on average. So they're going to peak in their spending at 46, and 46 was the peak back then, I can pretty well document. About 16 years later, okay? So when was that demographic peak back then? Largely from immigration? 1930. When is the stock market going to pick that up? 9 months ahead on average, okay? Late 1929. So what we had back in 29, the biggest bubble in history up to that point, okay? This one's much bigger, but back then, the only one close was the one that peaked in 1835-36, okay? Biggest bubble in history, low inflation, and a whole immigration backlash. Oh, we let too many people in. And of course, if immigrants are a strong source of growth, as they still are in this boom, not as strong as back then, and if you cut back on immigration, if we send 2 million people home, I'm telling you folks, that's a recession right there, guaranteed. Just 2 million people back across the border, not earning, not spending money here, okay? So it doesn't matter whether it's right or wrong, this is where we're at. This bubble is so much bigger, we can't compare it. Every major bubble in history, the bubbly part where stocks just divorce from normal growth patterns, okay? 5, 6 years max. This one has been full out bubble since 2009. So we're going on 17 and 18 years of a bubble, and worse on top of that by far, 100% fueled by artificial stimulus. The roaring 20s was strong immigration, demographics, boom, and falling inflation and technology surge, automobiles, electricity, all this great. I mean, that was massive back then. Electricity's one of the biggest innovations in all of history, okay? Along with computers now. So this is just like that, okay? And the economy looks fine until something goes wrong. Oh, and what did they do? Smoot-Hawley, Hoover throws on tariffs in June, I think it was June 17th, 1930, throws on tariffs when the economy's already just kind of starting to slow, and stocks back then had already peaked in late 29, a little bit, So here you go, another similarity, tariffs. Tariffs can only slow trade, and back then, by the way, after those tariffs in the Great Depression, trade between U.S. and Europe went down 2/3, okay? Part of that, the tariffs, part of it, just a Great Depression, and everybody gets protectionist. But again, that's why this looks so similar. We have a major demographic peak here, which has been extended by massive stimulus, okay? Now the stimulus since 2008 downturn, okay, which was the end of the baby boom demographic wave, which I projected decades before it happened. But in this case, in the 20s, we had the innovation 45-year cycle and the approximate 39-year demographic generation cycle peaking more together. Well, this time, the generation cycle peaked in 2007. The innovation cycle continued up until about 2019-20, just recently, okay? But even with that, all these cycles down into 2022, 23 or so, okay? So we've been living 100% on stimulus. And now we have a bubble beyond compare, and there's only one way this can go, and here's another little problem. We are running this year, they did back off on the balance sheet, okay? They're no longer printing money, they backed off 2.2 trillion or a little more on that, okay? So that's a reduction of stimulus, but we still have a 1.9 trillion deficit this year, which probably will only get worse. And if we have a downturn, I can tell you, folks, if we have the recession I see in the next year, say into 2026, 27 or so, that deficit almost guaranteed to double to 4 trillion. Now, all of a sudden, you got 4 trillion on a slightly lower GDP for the first time in a while. That could be 12 to 15% of GDP in 1 year, and then people, then yes, people have been talking about the U.S. dollar and the U.S. borrowing capacity losing its preferred, risk-free status. Well, this is what could finally do it, okay? It hasn't happened. I've told people we're still the best house in a bad neighborhood. We're still the reserve currency. And in a crisis, that gets more so. The U.S. dollar only went up, okay? Treasury bonds, our long-term treasuries, was the only thing to go up in the last part of 2008, where even gold went down to join stocks, okay? So that's what happens here. But this time, if we suddenly are looking at a deficit of $4 trillion with the debt we have now, and it going from 36 to 40 to 44, next thing you know, projections of 50 trillion, and on a slightly lower GDP, and that's 200% of GDP, whoa! Not sure what's going to happen there, okay, 100%. But this is the first time that our risk-free status, which we've always had for government borrowing, federal borrowing, could be questioned, and rates will fall with deflation in a downturn, as they did in 2008. The Treasury bond yield went down to 0.4%, okay? But this time, the U.S. Treasury may not have that big a fall and may not react as well, which will be a sign, oh my gosh, we are losing that status. So that's something for us to worry about later and see what happens. But I don't see any way here that with the tariffs, remember, Trump's been threatening these tariffs, but Trump's always, making deals and confusing, bargaining. Finally, these tariffs are just starting for real now. Now we see how much they slow the economy. They have to slow the economy, okay? And they have to increase inflation, which went down, below 3%, but now we can't get it to 2 and hold it there. So if inflation's trending back towards 3% plus and the economy's starting to slow, so signs of slowing, this is going to cause problems, okay? So I think that we are at that late 29 moment. I think stocks are peaking or have peaked already. And we're just going to have to see how this plays out. And the best way is to be safe. Now, people ask me, well, are treasury bonds the only thing? And the answer is no, okay? But you have to ask yourself how aggressive an investor you are. The real scenario, when I study past crashes like 2000 to 2002 and 2007 to 8 and to 1929 to 32, the big crashes, the bubble crashes, basically stocks, and I've said this a billion times, stocks will tend to be down 40 to 50% in just a matter of months in that first crash. The biggest hit is the stocks first, not to bonds. Bond yields will start going down, seeing slower growth, especially the treasury, the risk-free. But they don't go down that fast at first. They explode into the worst of the crisis, as in the second half of 2008, okay? Treasury bonds were the only things that went up in value, and their yields did go down to 0.4%. This time, they should go to 0 or negative, and they should explode even more, but we'll see how they do on the way, as this recession goes, because they may start losing some of that risk-free status for the first time, and that's harder to predict. So again, we've got tariffs, perfect trigger. They're just starting to hit. So now we'll see how much the economy slows and how much markets react to it now that it's just becoming real because Trump was so confusing about how he did it. And I'm not saying that's good or bad. That's just how he does it, okay? But the big thing we all have to look for now, what it's really going to take to say, big crisis, we have to start seeing debt defaults. Now look, even in the healthiest booms, you're going to see an expansion of equity offerings, you're going to see expansion of debt on companies and personal and consumers and household. Debt is going to grow with a boom, okay? And that's fine. even in the healthiest boom, there's going to be investments and debts that fail, okay? And then if you get in a downturn, those failures are magnified, okay? So we, of course, have, and I've documented this in the newsletter time and time again, record, and I mean by far records in zombie companies, you know? And of course, record debts at all levels, consumer, business, and especially government now, okay? And governments will explode in debt the most since they have to carry the weight of the downturn with stimulus and deficits that go from 1.9 trillion to 4 trillion almost overnight here. So that's what we're looking at. This is why we're in a safe position. That the safest thing for somebody is just sit. I mean, you can be in cash. That's the safest, okay? But cash is going to, you know, get you 3-4% in T-bills, and that's even going to go down to zero, okay, quickly, okay? The U.S. Treasury bonds, TLT, 10 and 30-year bonds, okay, Treasury bonds, is the best place to just sit this whole thing out. But the best strategy for a more aggressive investor is you start out being more short the stock market, knowing that the stock market gets the most overvalued in a bubble and reacts the fastest. And again, I've documented average crash 42% in 3 or 4 months, okay? That's what happens. And for the NASDAQ, that's going to mean probably 50%, and the S&P 40% or so, okay? So that, if you can be short that, I don't mean triple short and all that. If you're going to buy SQQQ, because it's triple short the NASDAQ 100 or the QQQs, then buy a third of it, okay? Downturns happen twice as fast and hard as upturns, so why be leveraged, okay? You don't have to be leveraged. Somebody can if they want, if you're a real trader, okay? But you're short stocks for the first crash, and when that gets towards 40 to 50%, which is what would be expected, then you can take your profits from that, and then you start putting the money in the 10, 20-year treasuries and ETFs like TLT. Those will do the best. TLT had its biggest gains in 2008 in just a couple of months in the second half of 2008, okay? So short stocks for the first crash, maybe the first 4 to 6 months, and then you get, and you can have treasury bonds to balance that out and stuff, but only treasury bonds. And then when that first crash has happened, stocks are going to have a big bounce. They're going to get more volatile. Then you just sit in the treasury bonds and wait for the bonanza, the box of gold at the bottom of the crisis when it happens, maybe out in 2027, 28 or something like that. If this plays out. And again, we know government's going to fight this, but they've already fought it now. Already $29 trillion in fiscal and monetary stimulus to keep a dead economy going since 2008, and more so when the technology cycle finally clicked out in 2019-20. Okay, so they're not going to win this one. You can't keep a dead economy going forever. Now the difference here, and one of the things going on which the markets don't understand, the reason for all this stimulus was the baby boom turned to the baby bust on that 46-year spending lag, the huge slowdown in spending. Well, that changed in 2008, late 23, 24, okay? The millennials are kicking in. We don't need stimulus now because we actually have generational spending growth, okay? Again, so that's why the economy's suddenly more buoyant, but we never cleared out, and now we have 29 trillion of stimulus to clear out, record debt levels, record zombie companies. We have to have a shakeout, and I think this is the time. If we don't see signs of weakness in the economy by early 2026, then something's wrong here, but that's what I expect now. I think we are at that late 29 point and pivot where we move from the greatest bubble and boom in history to the greatest downturn of our lifetimes, and I think it's going to be too fast and too hard for the government to stop. They will be late, like they've been, as Trump calls Powell, too late, whatever. They're going to be too late because this will come fast and hard. So I'm looking at here, I think we're at this critical point. The next 6 months will tell us if that's right or not, but for now, be safe. And yes, if you really want to make the most money in a short period of time, just be single short. Just be by 1/3 of your allocation in SQQQ because it has such high volume. It's better than PSQ in volume. So buy 1/3 SQQQ, more of your trader, whatever. These short stocks right now is the biggest profit, and sitting in treasury bonds is I think they bottom between 83 and 87, and they're only going to go up. My target's 186 plus on TLT if we get into a deep downturn. So again, I'll keep you updated. Fireworks ahead.